Well, thanks so much for putting the paper on the program. So this is joint work with Umang, Jane, and Joanna. Umang and Jane are here in the room, and you'll hear from them during the Q&A. Okay, so here's the motivation. Several recent episodes, for example, the 2023 banking crisis or the pension market crisis in the UK, have brought back attention on the interest rate risk exposures of different types of financial institutions. Now, interest rate swaps are one of the main ways through which these institutions manage their risks. And we know this is sort of a huge market, one of the largest OTC markets with trillions of dollars of volume traded every single day. But besides sort of some of aggregate statistics, for example, from the BIS, we don't really have that much data on the quantity side of this market, and in particular, covering large number of players, especially cross-sector data. And so there are two sort of broad strands of literature on the interest rate swap market, one that looks at asset prices. This literature has, because of lack of data, not sort of incorporated the quantities data in looking at asset pricing. And there's also literature on risk management. This literature tends to sort of focus typically a sector at a time, so whether or not banks hedge, what are the incentives of insurance companies, and so on. But for many policy-relevant questions, it is important to take a cross-sector perspective and think about how all of these different sectors come together in this market and interact with each other. That's going to be important, obviously, from asset pricing perspective. So sort of the total demand pressure in different maturities and the types of demand that we see could affect asset prices, because these are the risks that we are requiring the supply side, the dealers, to bear, and these imbalances could interact with frictions on the supply side to shape asset prices in this market. But it's also going to be important for how demand shifts in one sector affect hedging outcomes for other sectors in the economy. So for instance, if we force banks to hedge more, that might shift asset prices, and then that affects the hedging costs of all of the other sectors in the economy. But to the extent that they're elastic, that might also change their hedging demand. So these are sort of the types of questions that we're interested in tackling in this paper. And the way we're going to do that is we're going to bring novel transaction level data covering the near universe of interest rate swaps in the UK. Okay, and with these data, we're going to document some key facts about the market. And so I'm going to show you that pension funds and insurance companies act as natural counterparties to banks and non-financial corporations. They're going to have a lot of offsetting exposures that they're going to be swapping. And that means that the dealer sector has less sort of risks to bear than what they would have in the absence of this offset. However, at the same time, demand you're going to see is highly segmented along the maturity dimension. And so that these investors, banks and pension funds and insurance companies, are going to have extremely strong preferred habitats in certain maturities. And so that means that the dealer sector is going to have to take the opposite side in these positions, and they're going to be exposed to local maturity specific demand imbalances and pricing fluctuations. Okay, so then after that, I'm going to show you, we're going to basically estimate demand elasticities for these different sectors. And this is going to be an important parameter that is going to determine how demand shifts. So the extent to which demand shifts actually have spillover effects, that's going to be determined by these elasticities. And so we're going to introduce a new instrument that leverages a unique feature of the derivatives market known as portfolio compression, that is going to give us exogenous variation in prices that we're going to use to estimate these elasticities. Then with these reduced form facts and with these elasticities, we're going to then write down and calibrate a preferred habitat investor model that is going to allow us to decompose and quantify the different demand side and supply side factors that affect asset prices. And then with this model in hand, we're going to do some counterfactuals, so things that I alluded to before. So we are interested in understanding how demand imbalances in different maturities, how that affects different sectors in the economy. So both the direct effect as well as the spillover effects of these demand shifts. You could think of regulatory changes as a motivation for this, but you could also think of other sort of things that might give rise to demand shifts. So things like the product mix of pension funds and insurance companies changing, or the fixation of mortgage contracts changing, or demographic shifts and so on. Okay, so here's our data. So we're going to use regulatory data from the Bank of England. This is basically going to be very granular transactions and holdings data on interest rate swaps. And we're going to have a really large coverage of the UK swap market from December 2019 to June 2024. What's cool about this data is that we observe all of the end users that are in this market. Okay, so these are going to be over 6,000 entities that trade swaps that we're going to classify into four broad segments. We're going to have pension funds, LDI funds, and insurance companies in one bucket. We're going to call them PF&I. We're going to have commercial banks. Now, we spent a lot of time in the paper actually trying to make sure that these are not dealer banks. So keep that in mind. When I say banks, we mean end user banks. Okay. Third, we're going to have non-financial corporations. And finally, we are going to have funds that are going to be asset managers and hedge funds. And for each of these entities, we observe both their total outstanding position. So that's going to give us quantities. And we observe new flows. So we observe transactions. That's going to give us prices. And we, as you would have guessed, observe everything about these contracts. So things like maturity, the direction of the trade, the currency, etc. Okay, so here comes the first fact. As I said, pension funds and insurance companies have opposite exposures from banks and corporations. So what this is saying, we are plotting the net notional outstanding amount. So this is basically the received fixed positions minus the pay fixed positions. So anything positive on this graph is saying that you are essentially receiving fixed, so you're buying duration with swaps. Anything negative on this graph is saying you're paying fixed, so that means you're selling duration with swaps. So what you see here that consistently throughout the sample period in green, you see that pension funds and insurance companies are basically receiving the fixed rate, so they are buying duration. But in contrast to pension funds and insurers, banks and corporations are paying the fixed rate. Okay, so they're selling duration. Now I'm showing you a graph at the sector level, but this fact also holds at the individual entity level. And this makes sense because when you think about these entities, these institutions, these exposures are consistent with their underlying duration mismatch. So pension funds and insurers typically have really long dated liabilities, shorter dated assets. So to bridge that gap, these institutions should be buying duration with swaps, which is basically what you see. Banks, on the other hand, have the opposite maturity mismatch problem. So they have longer dated assets and shorter dated liabilities. And so you would think that they would do the opposite in the swap market, which is basically what we see here. Okay, and so what the end result is that there's less risk to be borne by the dealer sector in this market. By the way, they not only have opposite positions, but they also respond in the opposite way to interest rate shocks. So what I'm showing you here is that how demand changes with changes in interest rates, looking at unexpected monetary policy shocks. Okay, and you see banks have a positive loading, pension funds, insurance companies have a negative loading. So when interest rates go up, pension funds and insurers are reducing their receive fixed positions. Banks are also reducing their pay fixed positions. So they're both hedging less as interest rates go up. So this is sort of like the big picture point here is that they seem to have some sort of an opposite loading to like an aggregate demand factor that we're going to make sure to take account of when we write down the model. Okay. The second reduced form fact to keep in mind is that they have extremely strong maturity. There's extremely strong maturity segmentation. So pension fund insurance companies are trading in the long end. Banks and corporations are trading in the short end. So we take all of our positions, we split them into 4 maturity buckets, less than 3 months, 3 months to 5 years, 5 to 10, and 10 years and above. And I'm showing you 2 of the main maturity buckets, 3 months to 5 years and 10 years and above. What you see is that banks and corporations are primarily in the 3-month to 5-year bucket. And pension funds and insurance companies dominate the long maturity bucket. And it is the dealers that are taking the opposite position in both of these segments of the market. Again, not only at the sector level, but in fact, 90% of the institutions trade primarily in one single maturity bucket. Okay. And it is the dealers that are trading across maturities. They are going to be receiving the fixed rate in the short maturity bucket where banks are paying the fixed rate, and they're going to be paying the fixed rate in the long maturity bucket where pension funds are receiving the fixed rate. Okay, and so they're going to be exposed to demand fluctuations and pricing fluctuations in both of these segments of the market. Okay, Next, I'm going to show you how we estimate the demand elasticity. So this is going to be crucial for us because it's going to govern the extent to which these demand shifts will lead to spillovers. And so we need some sort of an instrument, exogenous variation in prices, to estimate these elasticities. So we have this instrument, new instrument that I'm going to talk about that's called portfolio compression, that is going to relax the balance sheet constraints of these dealers. Okay, but before I tell you more about the instrument, one thing to note here is that the notion of prices we have in mind is the swap spread. The idea being, as an end user, you could either use bonds or swaps. And so it is the relative attractiveness that matters. So we're going to look at the swap spreads, which is basically the swap rate minus the rate that you get on the bond of government bond of the same maturity. Okay, so what is this instrument? So the key idea here is that for dealers under Basel III, their leverage ratio requirements are linked to the gross notional amount of the derivatives portfolio. Okay, and what compression does is that it is going to reduce the gross notional amounts by netting off trades that have essentially the same cash flow dates and same characteristics, but are in the opposite direction. So as a dealer, you would sign up with the LCH ex ante, and the LCH is going to basically look at all of these trades, identify trades that are eligible to be compressed, and then they're going to sort of net off all of these positions, give you a net trade, net exposure that is going to be identical to what you had before, but your gross notional is going to come down substantially. Okay, and this has economically been a very large thing between 2016, 2019, about $2,600 trillion of trades were compressed. So on the identifying assumption, sort of the key idea here is as compression goes up, dealers are less constrained. And so they would want to trade swaps at worse terms than they were willing to do before. But what worse term means in this market actually would depend on what is the direction of the position the dealer is absorbing. And so, for example, if the dealer is receiving the fixed rate, then an increase in compression means that you would be willing to receive less. So you would see a decrease in swap spreads. And the opposite is true if the dealer is paying the fixed rate. So you would be willing to pay more with an increase in compression. And so you should see an increase in swap spreads. So that's basically what you see in this table on our first stage. In the 3-month to 5-year bucket, the dealers are receiving the fixed rate. Remember, banks are paying the fixed rate, so dealers are taking the opposite. You see a negative coefficient. And in the 10-year and above bucket, you see a positive coefficient. Remember, again, dealers were paying fixed rate because pension funds are doing the opposite. Okay, so the key idea of the exclusion restriction is actually based on which trades are eligible to be compressed. So to be compressed, trades have to actually have the exact same settlement dates, exact same cash flow dates, and exact same characteristics, but they have to be in the opposite direction. And this, we argue, is likely to be random across dealers, and that's sort of the variation we are exploiting to identify these elasticities. Okay, so on the second stage, we're going to look at the relationship between these instrumented swap spreads and the quantities. And so first thing you see that the signs are positive. That means as swap spreads go up, so that makes sense. As swap spreads go up, you should want to receive more. And so that's exactly what you're seeing. In terms of magnitudes, we have that banks actually are more elastic than pension funds and insurance companies, even though admittedly our estimate for pension fund is noisy. And so what we're going to do in our calibration exercise is that we are going to sort of not calibrate to these point estimates, but we're going to look at the entire distribution of these reduced form estimates as an input to the model. Okay, great. So in the, how am I doing on time?
6 minutes.
Oh, okay, great. Perfect. So in the last part of the paper, we're going to write down and calibrate a preferred habitat investor model. So that's going to be based on Viceira and Vila, and we're going to account for frictions on the dealer side. So on the demand side, we have these end users, their preferred habitat because they trade in single maturity buckets. Okay, so the demand is going to have 3 components. So the first component is that demand is downward sloping in swap spreads. And these alphas in front are the demand elasticities. The second component is that we have an intercept term or a demand pressure term, which is basically accounting for the fact that you may have like this natural demand for swaps because of your underlying balance sheet mismatch. And the third component is a time varying component that is basically you may have, there's an aggregate demand shock, which is beta 1. And we would allow these investors to be, they are heterogeneous, they're going to have different loadings on this aggregate demand factor. In fact, we will allow them to be even in the opposite direction. On the supply side, we have dealers that are mean variance agents. They are subject to this time varying balance sheet funding cost CT. And they're risk averse. So their risk aversion is meant to capture things like their internal risk limits or things like regulatory constraints and so on. Now, one assumption that I should point out is that we're assuming, and we're drawing this assumption from the literature, that the dealers are actually hedging all of their interest rate risk by taking offsetting position in bonds. But they are going to be exposed to fluctuations in swap spread. So that's going to give rise to mark-to-market changes in the balance sheet. And then we're going to basically let markets clear. We have two sources of risk in the model. We have the balance sheet funding cost of dealers on the supply side, and we have demand shocks on the end user side, and we're going to allow them to be potentially correlated with each other. Okay, so we're going to solve the model, we're going to discretize the maturity space, draw demand elasticities, as I said before, from the entire distribution of reduced form effects. We're going to calibrate the rest of the parameters, targeting the averages and the variances of spreads and quantities. And then we're going to calculate counterfactual effects. You're going to see a whole distribution of them because we're going to draw from a whole distribution of demand elasticities. And we calibrate this model for two different subsamples. So interest rates changed a lot during our sample period. So we're going to have a low rate period and a high rate period. Okay, so in terms of results, I will just highlight a couple of them. So the estimated demand parameters that we get are very consistent with the reduced form facts. So for instance, on the demand and intercept, for the 3-month to 5-year bucket, we find a negative number. For the 10-year and above bucket, we find a positive number. So this is saying like the agents in the model are paying the fixed rate in the second maturity bucket and receiving the fixed rate in the fourth maturity bucket, exactly consistent with the reduced form facts. And we also get opposite loading on the aggregate demand shock, exactly consistent with the reduced form facts. Okay, good. So we do several different things with the model. I'm going to highlight one of them in the interest of time. So we are interested in trying to understand how demand shocks in different maturity buckets, how does that affect the shape of the swap spread curve? And as I said, the motivation could be anything. It could be demand shifts due to regulation or changes in product or mortgage fixation and so on. So the way we're going to implement this in the model is we're going to shut off this demand pressure, the demand intercept term that I showed you before, for different sectors, one at a time. Okay, so the gray line shows you the baseline swap spreads in the data, familiar shape negative swap spreads in the long end, exactly as you have in the US. Now, what happens if you shut down the demand pressure for banks, you're going to see a downward shift. The whole curve shifts down, downward shift in spreads. That makes sense because now you have less offsetting demand from banks. So dealers have to now hold more pay fixed imbalances from pension funds and insurance companies. And so they should want to pay lower swap rates. So that's what this is saying. Importantly, there is an effect in the second maturity bucket where we shut down the demand, but also in the fourth maturity bucket. So there are spillover effects of demand shift as this is showing. And the same sort of result holds if we shut off the demand pressure for pension funds. The entire swap spread curve moves up. Now, one thing to note is that these effects are much larger when we change demand for pension funds. And that's because changes in the long end would matter much more because dealers have to hold longer maturities. And that is more risky for the dealers. So now we are going to ask, because we see that there are both local effects in the maturity buckets where we are shutting down demand, but also spillover effects. So we're going to ask, how does sort of changing demand of these different end users affect hedging costs of all of the other sectors? So what this is on the left showing, the left graph shows you what happens if banks hedge more. So this is us implementing the 20% shift in demand in the second maturity bucket. And the right-hand side shows you what happens when pension funds hedge more. So what we're plotting here is the difference between the counterfactual spreads that we get from this exercise minus the actual spreads. So what you see is that there's an increase in swap spreads in the second maturity bucket. That means that it's much more costly for banks to hedge because remember, they're paying the fixed rate. But swap spreads are also going up in the fourth bucket. But that means actually pension funds hedging costs go down. And that's because these pension funds are receiving the fixed rates, the swap rates are going up. And so that's a reduction in their hedging cost. In the 10-year bucket, again, the same thing. There's a big increase in the hedging cost of pension funds if we force pension funds to hedge more, but there's actually reduction in hedging cost for banks. Again, our back of the envelope estimate suggests that if we force, for example, banks to have 20% more hedging demand, that's going to cost banks about 150 million more over the lifetime of the swap, but save pension funds and insurance sector about $2 billion. Okay, so with this, there's a lot of other things we do in the paper. So just to sort of give you a sense, we look at how these estimates change if demand becomes more inelastic, what happens if dealers' risk aversion changes, what happens when there is less segmentation in the market, and so on. So these things are in the paper in case you're interested. Okay, so I'm out of time, so let me conclude. So to our knowledge, this is sort of the first large-scale cross-sector study of the interest rate swap market. We show banks and corporations and pension funds and insurance companies are natural counterparties in this market. And we explore what the role of demand imbalances and show that that's actually quantitatively important in affecting the swap spread curve, the entire shape of the swap spread curve. And that allows us to sort of quantify these spillover effects of demand shifts that we do. So there are obviously implications for asset pricing in this market, but potentially also for risk management and how we want to think about designing regulation across sectors. Okay, thanks so much.